Hi, I take you through the events of September 2022 affecting the fixed income markets globally and in India. The RBI came up with the Monetary Policy Committee meeting and it announced a 50 basis hike in repo rates. Repo rates are today at 5.90, and this was as per expected lines. And the RBI, what it also did was just pruned a bit of a GDP growth to around 7% from 7.2, and inflation broadly unchanged through the year at around 6.7%. But more interestingly, next year in September, they are expecting inflation to crack down to 5%. So that's the context. And for in the month of September, it was difficult both globally and in India. In India, the short-term rates moved up by 50 basis points. The long end of the curve, the 10-year, moved up by 15 basis points to close at close to 7.35. Globally, you had an extremely hawkish central bank, specifically the US central bank, raised rates by 75 basis points to 3.25, and the expectation is that the terminal rates close to 4.5. And in all Fed's interaction, they're talking about a slow economic growth and a Fed-induced recession, which is basically Fed, through the actions of Fed, they trigger a rise in unemployment, which will lead to finally inflation softening, and thereof probably the rates also softening. So what's our outlook from here on? We believe the fact that we are close to the terminal rates on the RBI front, and similarly close to terminal rates on the 10-year. Most of the portfolios, barring a liquid, carry a YTM of close to 7% plus. So if you're on the risk continuum, on the short end of the curve, you can safely move on to start moving to the longer end of the curve. It's a good entry point, and the margin of safety is definitely in favor of fixed income investors here, as portfolios are today carrying a YTM of close to 7, which gives them a reasonable margin of safety over inflation and other traditional fixed income products. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.